Are you retired, unemployed, or self-employed? You're having trouble qualifying for a mortgage because you don't have traditional income? What if the lender could use the assets you already have to calculate your qualifying income? That's the idea behind an asset utilization loan. Here's how it can work. Let's say you have 500,000 in a 401k or IRA. Most programs use 70% of those retirement assets to qualify. That's $350,000. Now let's say you have another $200,000 in savings or other non-retirement assets like mutual funds, stocks, bonds. Most programs qualify those at 100%. That's another 200,000. Now you've got 550,000 in qualifying assets. Here's where it gets interesting. Many non-QM asset utilization programs calculate qualifying income by dividing the qualifying assets by 60 months. So 550,000 divided by 60 equals 9,167 per month gross income. The lender can use approximately 9,167 a month as qualifying income subject to that specific program guidelines. Now that means you could potentially qualify for a mortgage based on the wealth you've accumulated rather than relying on a paycheck. This can be a powerful tool for retirees, people between jobs, investors, even business owners whose assets are substantial but whose traditional income doesn't always tell the whole story. Now, here's an important part. Not every lender calculates assets the same way. The percentage applied to retirement accounts, eligible assets, reserves, loan to value, even credit requirements, and the 60-month calculation can vary by program. For example, the Fannie Mae Freddie Mac programs have a much longer depletion period, so the qualifying income can be relatively small. This confuses a lot of people because these mortgage types take your assets and divide it by 360 instead of 60. So if I lost you on QM and non-QM, a QM or qualified mortgage generally meets standardized federal underwriting requirements for income, debt, and ability to repay, while a non-QM loan offers more flexible ways to qualify, such as a 60-month asset utilization, bank statements, even DSCR, in exchange for potentially higher interest rates or fees. So asset utilization non-QM loans that divide by 60 months generally carry a rate premium over a standard qualified mortgage or QM conventional loan. But the spread is much smaller today than it used to be. As of August 2026, a reasonable assumption is roughly 1 to 2.5% higher for a non-QM to divide it by 60 months. So anyway, if you have substantial assets but limited traditional income, don't assume you just simply can't qualify for a mortgage. For more tips on mortgage loans and real estate options, visit briantherealestateguy.com.